Thank you, Amit Bhai. Good evening, Chirag, Deepak Bhai, and my co-conveners, Rutvik and Karthik. I would be sharing my screen at the moment, so we can start with the presentation. Is it visible, Hardik?
Yes.
So first, we will go through the due dates for assessment year 23-24, and we'll see how the types of ITR are available on the income tax portal, including the different new ITRs that have been introduced for assessment year 23-24 Finance Act onwards. There will be an explanation for the changes in the ITR that we're seeing that are only applicable for this year, which are different from the last assessment years. We will be going through the important schedules in the return of income, which you will have to be really careful about while filing the return. Special focus on the ITR 7 because as a date, Form 10B and 10BB, which are the audit reports for charitable trust, have become very, very difficult, tricky, and they also have a lot of nuances that we need to understand with the current law and amendment. Information about revised, belated, and updated return, how to file, when to file, and what are the nitty-gritties therein, and some special points from my end. I have made a summary of my understanding about the return that you audit, you compute, you prepare for TDS and GST, you incorporate, you close down, and whatever you do, you have to file the return of income. Like Amit Bhai said, we are liable to file the return of income, and also it is our duty. Once you begin filing, you cannot turn. When you e-file the sections and rules that you learn, you and the midnight lamp's oil will continue to burn. Some rules that you must be aware of before you start filing your return and start taking client work. Rule 12 explains how to file the return of income, how to e-verify different ITR from 1 to 7, and so on. Rule 12 AC talks about e-verification and verification of updated return. Rule 128 speaks about how to take and claim foreign tax credit in the case of resident tax Indians, where you have to file Form 67. Rule 115 explains the multiplier of the exchange rate for the foreign income that a resident Indian has received and how to disclose that in Schedule FSI and FA. We will see it. Rule 21 AAA, which is linked to Form 10 EE, is for that section which is named as 89A, where you need to claim any kind of a credit for the taxes that you are paying in India, although you have not received that income as yet. I will explain you in further, but this is mainly applicable for those Indian citizens or those tax residents who are presently resident, but once upon a time were NR in that particular year in India, and they were resident of the foreign country, where the foreign country said that on the retirement fund account, we will be withholding your taxes in the year in which it will be received by you. Whereas in India, as we follow section 4 and 5 for accrual of income, India will levy a tax. How to claim that, how to disclose in the ITR is what we will watch. Rule 37BA goes to TDS and TCS claim in the hands of others, which is showing in your 26 AS. Rule 41, how to claim refund after you have filed the ITR. 6F talks about maintenance of books of accounts for the specified assessees mentioned in section 44 AA, who are those professionals like chartered accountants, film artists, technical consultants, engineers, doctors, etc. Rule 17 AA has been introduced very recently for the maintenance of books of accounts by charitable trust, which will also be reflected in your Form 10B and 10BB. Here are some due dates: 31st July, forthcoming due date for non-audit cases for all the assessees mentioned herein. 30th September will be an applicable due date for tax audit for individual HUF, BOI, firm, LLP, etc. Now the due date for its ITR would fall upon 1 month thereafter, which is the 31st of October. However, your revised return and belated returns due date remains the 31st of December of this year, after which you can only file an updated return and there will be a lock on the CPC. For charitable trust, 31st May went by where every charity trust had to disclose the donations that it received in Form 10BD, and on the same day or before that day, they had to issue the receipts, which are known as 10BE, the statement of donation, and receipts thereof to the donors. Those charitable trusts who have not exceeded the maximum amount chargeable to tax, like an individual 2,50,000 as gross receipts of the charity trust, will file their ITR by 31st of July. However, if they've crossed that limit, they would be applicable to filing the audit report on 30th September. One point to note is that ITRs also mention that in case you are applicable, section 139 subsection 1 says if you're applicable to any other audit under any other law, your due date literally shifts from the 31st of July to 31st of October. So let us suppose I'm a charity trust registered in Maharashtra or perhaps Gujarat, and I have crossed rupees 10,000 as the threshold of the charity commissioner. I will be filing my charity commissioner's audit report before 30th September, and hence I will come out of the 31st July due date and my return filing due date will become 31st October. This year, there is a slight change in case you have an accumulation of income and you want to accumulate it for 5 years and put it in an investment, you will have to mandatorily file Form 10 before the 31st of August. That means that even if the Charity Commissioner's Office wants your financial statements and audit report by the 30th September, you will have to do the audit perhaps 1 month earlier. Similarly, for 1 or 2 years accumulation, which is explanation 1 of section 11 subsection 1, you will have to file Form 9A on before the 31st of August. On the 31st of October, you will be filing your ITR 7. For corporates, the tax audit due date is 30th September, unless and until you go for a transfer pricing audit. So your due date will become 31st of October. And if you are applicable only to tax audit, your ITR is 31st October. However, if with TP, you will have to file your ITR 6 by 30th of November. Some due dates for master files for those clients who have entered into international transaction, having a parent or being a subsidiary in India, they will have to file their master file. And in case you are a subsidiary having a fellow subsidiary in India, a sister concern in India, you will have to say, look, I am A Limited, my sister concern B Limited, example in Pune, and I being in Bombay, I'm filing master file Form 3CE AA by the 30th of November. This thing you will disclose on the 31st October in Form 3CE AB by ensuring that you're declaring your sister concerns detail, that you are part of the same parent, same ultimate group. Country by country reporting, 30th September, which is 1 month before filing of the transfer pricing report. However, if you are applicable to MAT, you will have to file that before the 1 month of ITR due date, that is the 30th of September. In case of transfer pricing and MAT both, the MAT applies 1 month before the ITR due date. That's why it is 31st of October. Let us briefly look at the returns of income for this assessment year. ITR 1, not at all applicable for NRs, because NRs will necessarily have to come out of ITR 1 and go to ITR 2. RNOR will also have to come out of ITR 1 and file ITR 2. If you have an agriculture income of more than 5,000, having house property more than 1, then you will have to come out of ITR 1 and file ITR 2. Now, let us suppose I'm a salaried individual. Whether do I need to only file ITR 1? The question arises whether I'm a director of any company. The answer is, if you are a director in a private limited company or a public limited company, you cannot file ITR 1, even though your only income is perhaps the savings bank account or savings bank interest account or the salaries income. So you will have to go to ITR 2 and fill the entire ITR 2. ITR 3 is applicable for those assessees, individuals and HUF who have business and profession, and even if they have presumptive taxation, they may fall into ITR 3. Why am I saying that? And why is presumptive taxation and ITR 3 related? Although we say that once you are into presumptive taxation, you are a eligible assessee and you cannot show any other income under different business head from section 28 to 43C. Let us see how ITR 4 will be filed. If you have a gross total income up to rupees 50 lakh, and if your agricultural income is less than 5,000, only then you can file ITR 4. But if your gross total income increases to more than 50 lakh of rupees, you will have to go to ITR 3, where you will also have to fill Schedule AL, which is assets and liability, where your assets and liabilities will only be those which are not forming part of scheduled balance sheet. This does not show, ITR 4 does not show information of directors and unlisted shares. So in case, even if you are showing anything under presumptive taxation, then you will have to go to ITR 3 and show yourself as having unlisted shares and being a director in a company. ITR 5 is applicable to partnership firms, LLPs, including artificial juridical persons. Let us say I have an estate of a deceased, and perhaps not in an individual capacity, but I am showing it as a person who is legally in charge or as a legal heir of the estate, and perhaps your client has applied for a PAN under the AJP provision. Also, gymkhanas will also have to file ITR 5, which is AOP BOI. Specifically in the AOP BOI, you will have to show correct information of the members of the AOP BOI, which I'll show you in the next slide. ITR 7 has completely changed. It has become a 33-pager ITR from two sections, there are two sections in the ITR, Part A and Part B. Part A is massive general information, and Part B is a supermassive information about various accumulation, various income, various disclosure of the entire charity trust. So one will have to be very careful and first understand the income tax law of the charity. The utility has just been released on the 30th of June. However, some parts of the utility seem to be locked when I was trying it. We hope the best that we can file in the ITR 7. ITR U is what I will cover later, so I directly go to ITR A, which is a modified return in case companies go for business reorganization like merger, amalgamation, etc. under the NCLT and the court's order. You will have to see Rule 12 AD for verification and Section 170A, who has to file, how has to file. And the answer is that the successor company, the resultant companies, whether one or two, will have to file the modified return within 6 months from the date of the order of the court. So here is how the question would look like, whether you were a director in company during the previous year or not. And only if you put a yes, then the fields come up and you will have to give the information whether you are also having shares in that company or not. This is why I was explaining that the difference between ITR 1 and 2 has only this field, which is mainly different and which is more crucial for those assessees who are salaried and are directors in a private limited or a public limited company. Changes in the ITR. The non-applicability of ITR has now arose from assessment year 23-24 in case you are applicable to section 139 subsection 17 proviso, wherein you have deposited an amount or aggregate amount of exceeding 1 crore in your current account, whether one or more current accounts. So let us say I deposit 70 lakhs in one current account and I deposit 80 lakhs in another current account. I've crossed 1 crore in an aggregate, and hence I will come out of ITR 1 and perhaps I'll have to see what kind of ITR will be applicable to me depending on other kind of income, but ITR 1 is shunned. Second change is virtual digital assets, schedule BDA. If you take a close look at it and see column 2, you will have to mention the exact date of acquisition and then the date of transfer. You will have two options to pick, business or capital gain, in the mode in which you have made and invested, whether you are holding it as an inventory, which will translate it to business income. And if it is an investment, it will translate to be a capital gain. The difference of the two will come in column 7. However, the consideration received will be exact, and the only expense that you get is the cost of acquisition. If you have received it as a gift, you will have to show the cost of the donor to you. There is no indexation allowed under this section. Under 115 BBH, there is a direct tax of 30%. A special tax column has been added in schedule BTI, which is the total income, to show this special income separately. Automatically in part A and B, the breakup will show respectively. What I mean is, for example, if I'm showing Ethereum as my business income and I'm showing Dogecoins as my capital gains, you will see the breakup accordingly in part A and part B, because you will be using two different rows for both the kinds. It is preferable to show total business income and total capital gain rather than showing different digital coins or different VDAs under different rows, because the return will become massive and you'll have to do a lot of reconciliation. Some important changes which have come in the ITR, which I've already covered as at the moment. I will be taking up ITR 7. In balance sheet schedule, there is another column which has been added under the trading account head, which says turnover from intraday and income from intraday trading, which will be transferred to the profit and loss account. So let us say my intraday turnover. How do I define that? The intraday turnover, as per the tax audit guidance note released by the ICAI, is the positive and the negatives summation. So let us say I did an intraday for 100 rupees and I did another intraday for negative 300. My total is 400. So my turnover is 400. If I find out what is my income, which is going to intraday trading, it will tend amount to show me what I want to transfer to profit and loss account after the expenses. We see here that there is no way we can show expenses. So we will have to compute it separately and show the intraday income, which will extrapolate into part A profit and loss account under row 13. If you see, the total is 12 plus 12B. If I can move my cursor here, it's 12 plus 12B, which is the total of the total, which is non-intraday income plus intraday income. Section 115 BBI talks about specified income at 30%. Specified income is defined for charity trust, which are violating Section 13, Section 1023C, Proviso 21 and 22. They say that if you're violating any kind of accumulation of income or you have paid related parties, the application will become actually your income and there is no exemption, and hence it will be directly charged at 30%. A different slab has been mentioned in the ITR 7. Initially, we used to see in TDS schedule that TDS in my 26 AS could be taken as a claim in somebody else's return. For that, I will have to inform the deductor that you need to give me a declaration that this TDS is not mine, it belongs to some other PAN. That declaration has to be maintained by the deductor under Rule 37BA, and only then can you say that yes, this is not my TDS under AIS. You will have to deny or show it under another PAN, and the person who wants to claim it will claim it in the scheduled TDS of his return. Similar provision has been extrapolated to TCS under Rule 37BA. It seems there is no specific provision or rule for TCS deducted for others in my 26 AS. Hence, Rule 37BA is extrapolated by some citations which I've read, and Schedule TCS has now a new column which says in others' hands. This is now a little crucial part because we're looking at ITR 7. Initially, if a charity trust was registered under the income tax, it will have to give two details under general information: a provisional granting approval information and registration details of the final granting of approval. However, if you have got the final approval, you do not have to disclose the provisional registration of approval. But if you haven't received it yet, you will have to continue showing the provisional registration as well. Initially, a maximum marginal tax rate applied under Section 64, which is clubbing of income to charity trust, that has been removed apparently from the ITR 7. And in replacement of that, there is a question which says whether provisions of the 22nd Proviso 1023C and 1310 are applicable. Now, what are these sections is what I will move to. Section 1013 speaks about violation of registration, the purpose for which you have taken a registration under income tax as a charity trust. You have violated 215, where you have moved out totally into trade and commerce, which is more than 20% of your gross receipts. And you have also, or else you have also given any benefits to Section 13 parties, which are related trustees, managers, etc. In case of these violations, you will have to put a yes in your ITR, which is A26 in general information. Initially, you were always being asked details of authors, trustees with their Aadhaar number in the ITR 7 as at the date of application of registration. So now the difference is that you are not being asked as the date of registration at the date of application, but you will be informing the income tax that here are my authors and founders and settlers on the during any time during the year. So if, for example, financial year 23-24, even if I was a trustee in a charity trust, even for one day, I will have to make that disclosure. The new animal in ITR 7 is consolidated balance sheet named as Schedule BS. It explains the sources of income. So thankfully, you do not have to show the entire income and expenditure account. However, the income and expenditure account is now shown in Part A, which we will just see. In the balance sheet earlier, there was a small part of the balance sheet which was disclosed in assessment year 22-23, where we had to disclose the ITR. We had to disclose the details of the investment. Now, the details of investment fell into two categories: investment under 11.5, where you had to do it according to the income tax rules by accumulating the income, or they were otherwise. Now, there's only one single item in ITR 7, which says under the balance sheet item, there is single item called as investment, and the grand total of investment reflecting in your balance sheet will have to be disclosed therein. This is a short detail about 1023C. I would like to skip it at the moment because it's quite tricky, and I will request BCS and our committee, tax committee, to hold a different event or a webinar for 10B, BB, and ITR 7 that we should be doing shortly. All right, this information is actually a total compilation of what kind of expenditure will be disallowed because you have violated 1310 and you have violated 1023C. 1310 is actually a mirror replica into 1023C 22nd proviso. What are these? 13 subsection 10 talk about the benefits that you've given to the trustees, and it correlates with 13 subsection 8. So section 13 subsection 8 and subsection 10 are very important for you to understand that what kind of benefits given to the trustees or authors or related parties could come into violation. The entire section actually now has been encrypted in this schedule, as you see, from point number 2 up till point number 4. Any kind of additional income, which is even special income, is under 4.1, 4.2, etc. for any kind of specified income that the trust has earned or accrued during the year. Schedule A. Schedule A is totally new. Initially, we used to have Schedule ER, which is expenditure in format of revenue, and EC, expenditure in the format of capital. Expenditure revenue, expenditure capital. ITR 7 has merged both the columns into revenue and capital and called it a Schedule A. It is asking you a simple question that if you're a charity trust registered under the Income Tax Act, whether under Section 1112AB or Section 1023C, how have you applied your income? Whether have you applied through capital or for the purpose of revenue, and the grand total will appear in the last column. Schedule D and DA. If you see column 5, it is actually a summation from Schedule DA. So actually you will have to fill Schedule DA first to finish Schedule D. What is this? The Section 11 subsection 1, explanation 1 is very important, that in case I have not received my income during the year, but I've earned it as a charity trust, I can apply it. I can so-called call it a deemed application. And when in the year in which the income is received, I can just say that now it is not taxable. And because I have already applied it and the year in which it is received, I will have to show the details there too. So the entire breakup of when I had earned, when I had applied, what I had applied, whether I had carried forward for another year or so. Maximum you are allowed to carry forward for 2 years, And after the second year, in the third year, it will become taxable. Again, a very cryptic section, because you will have to maintain the records of the past 2 to 3 years and take a look at it carefully. While you're filling Schedule DA, you will have to see assessment year 17-18 up to assessment year 2021, the first column, and thereafter horizontally. So if you add up A plus B plus C plus D plus E, your total will reflect all the 5 columns total, and that total will come under column 5 of Schedule D. This is to be referred to 11.1 explanation 1 clause 2 with subclause 1 and 2, whether you have accumulated because you have not received the income or is there any other reason, will have to be informed in this schedule. Schedule I, it was always there. Schedule I is for those charity trusts who want to accumulate the income and have spent less than 85%, and the balance wants to be accumulated for next 5 years. And that money has to be invested before the due date of filing of return into investments specified under 11 subsection 5. The new columns 6 and 7 are again attached to Schedule IA. Again, IA and DA are quite similar, and their logic are parallel. So without going into much details, because the law is so immense and big, that I just like to show you how that works, that the total of Schedule IA will actually come in your sub column 6 out here, as I highlighted. Schedule J is explaining the details and the breakup of the corpus. The first column says representing donation received for the renovation repairs. As per the new amended section, any charity trust receiving corpus for the renovation of Gurudwara, mosques, temples necessarily will have to show that income under the corpus. The same amount will have to be applied only when it is first invested under 11.5 modes of investment. This breakup has to be given in Schedule J, and Schedule J is then correlated with loans and borrowings. Loans and borrowings until repaid cannot be shown as application. Because of the changes in the law and such a big massive change, the ITR has changed accordingly. Schedule R, again a new animal in ITR 7, because it is showing you a reconciliation of corpus as at the date of balance sheet and Schedule J. So you will have to see your balance sheet, Schedule J, the corpus, Schedule I, and Schedule R. Perhaps it seems that I will have to come out of ITR 7, prepare a reconciliation as a maker of ITR 7, and do a massive reconciliation in case there is a corpus and different kind of corpus available, not only for those which are for renovation, but for perhaps any other earmark corpus. Breakup of purchase of fixed asset, depreciation, any other asset in Part B will have to be given, and whatever is in Schedule J will come here. But honestly, when you look at Schedule J and R, it is very difficult to explain as long as you have not done it practically. So I'd go further. This is the same information that in case you are holding an investment as a trustee in any kind of an entity where your trust itself has invested. So let us say I have invested in Aditya Birla Mutual Fund, and the trust has already invested in Aditya Birla Mutual Fund, and as a trustee, I am a related party to that so-called mutual fund. I will necessarily, as a charity trust, disclose the name of the concern here, because I will show only when there is a substantial interest. Now, the definition of substantial interest is 5% of that value, and hence only if that is so, you will show here. So the second question arises, what if I'm below the threshold of 5%? The answer will be ticked on as no. So the details of that concern will have to be disclosed here with a nominal value of investment, and I'll also have to disclose whether what is the income from the investment that the trust has earned. Schedule BBI has been put in 115 BBI, as I said, it is 30%. Schedule VC, which is a voluntary contribution. Initially, there was no breakup of anonymous donation under 115 BBC, whether it is a foreign contribution or a domestic contribution or a corpus donation. Now, there is a part D to Schedule VC, which says foreign contribution is to be disclosed only without anonymous donation, and voluntary donation in the form of corpus, and also non-foreign contribution will have to be shown without anonymous donation. So anonymous donation, if you've received from foreign or non-foreign items, will have to be shown in part D of the same schedule. Only the bifurcation has ended. Political party, whether you've recognized by Election Commission of India, and the date of recognition is the only change in Schedule A, LA, and this political party will be filing the ITR under 139(4)B of the Income Tax Act, whereas a charity trust will have to file the ITR under 139(4)A. What happens to venture fund? 139(4) E will come into place, and 4F is applicable to investment funds. Thankfully, we're done with ITR 7, and I feel more happy because I'm talking about certain changes which are neat, but one will have to be very, very careful. A new item, place, has been added in ITR 5 and 6 under the verification box. Initially, this was missing in the earlier ITRs. The very important change that has come in ITR verification for those who are manually signing. Now, let us see what are the ways in which we can e-verify the ITR. Preferably, I would go with Aadhaar OTP for those who are linked to the Aadhaar, and those clients, including LLPs or private trust, AOPs, BOIs, whose Aadhaar are linked to the CPC profile. ITR are actually explained by Rule 12, where Rule 12 explains you what are the ways in which you need to e-verify your return. For those individual HUF applicable for tax audit, you have to mandatorily use your digital signature. You can also skip using digital signature if you're not applicable to the tax audit provisions. In that case, you can do EVC, electronic verification code, by knowing that certain banks listed on the income tax website are being held by you, in which your mobile number has to be same in the bank account, and the mobile number of that same SIM card has to be attached to your CPC profile. There cannot be a separation of a different mobile numbers, because the OTP will come to you only then. That OTP is only valid for 72 hours. In case you are sending it through speed post, the rules have changed now. If your ITR is filed on the 30th of June, you need to speed post it before the 29th of July. If you send the speed post after the 29th of July, 30 days henceforth, the date of e-filing will be considered as the 30th of July, the day after the 30th day. However, what happens if you are sending it after the 31st of July? There is no mention in any kind of FAQs. One can look at the 73 FAQs by taxmen that has been published. Also, there has been no mention whether the early 120 days are still valid for the ITR to get invalid. Initially, what used to happen was I could sign by speed post in 120 days of e-filing the ITR, but now that has been limited to 30 days so that I can save my time, I can save my correspondence, and I can also save my interest under 234A, if any, or B also. ITR verification for ITRU updated return are encrypted in Rule 12AC. It mandatorily says that you have to get a digital signature certificate, or you have to do through EVC. You have no option for updated returns to be only be filed by these two modes, and there's no option for you to file it manually. The notification 5 of 2022 dated 29 July 22 can be referred. Once the ITR-V has been e-verified, it becomes an acknowledgement. So when you see ITR-V, it is actually not your acknowledgement. It is a verification form, which are under the income tax rules, and your confirmation about ITR-V turning to acknowledgement will be sent to your email address, which is hanging on the profile settings of CPC, not what you've mentioned on the ITR. Here are some FAQs, which are literally what I just said, but there is no clarification whether invalidation of ITR begins after 30 days or 120 days. I would presume invalidation can only happen after 120 days because there is a silence. We will be going through some of these schedules and how they affect our ITR. I will just, for the sake of clarity, say that Schedule TR is the tax relief. Schedule AL1 is applicable to unlisted companies. And the purpose is that they want to understand what are the breakup of your assets and liabilities, although those assets and liabilities are sitting in your ITR 6 balance sheet and also signed audited financials. SPI is a special person income. If I have a minor daughter whose income needs to be clubbed in my return, I will have to give her name, PAN, and show the income by claiming 1,500 rupees per child as a exemption under 1032. Schedule IF is income from firms. Schedule OI is a very important schedule where your tax audit is, when your tax audit is applicable, you will have to fill Schedule OI to see what kind of disallowances and allowances are attached here, and that will be matched with Schedule BP. The total of Schedule OI will actually reflect in your Schedule BP. In case of any mismatch, you will definitely get an intimation for any kind of addition or deletion that you've missed out on. Let us see how Schedule FA needs to be filled out. Schedule FA is applicable for resident and ordinary residents only. Let us say I have a foreign share in the month of January 2022 that I've purchased. I will have to disclose that in my Schedule FA. However, if during financial year 22-23, even if January 23 comes into that block of the year as per Indian FY, I will not have to show any kind of purchase of foreign assets or disclosure of foreign asset that I'm not holding up till or after 31st of December 2022. So if I purchase Facebook Inc. on the 1st of January 2023, I do not have to disclose in current year's return under Schedule FA. What is the interplay between Schedule FA, Schedule unlisted shares, and AL? Those foreign listed shares which are on a foreign stock exchange do not have to be disclosed under Schedule unlisted shares. There is a clarification in the instructions of ITR 3 and ITR 2. I will only have to fill Schedule AL for ITR 2, 3, and perhaps show all my assets and liabilities, including all kind of investment if I'm ROR under Schedule AL if I cross gross total income of rupees 50 lakhs. Now what happens if I am talking about Schedule FA and Schedule AL? The answer is yes. If I'm filling Schedule AL and I've crossed 50 lakhs of gross total income, those shares will again have to be reflected in Schedule AL. So perhaps this could be called as a double disclosure. What if you're a signatory outside India, whether ITR is applicable? The answer is yes, because you fall under the explanation 4 of 139 subsection 1. Even if you're a beneficial owner of any kind of a foreign asset outside India, the definition of foreign asset beneficial owner is any individual who has direct or indirect consideration or has held an immediate for foreign benefit. So if you are an individual who has paid a consideration directly or indirectly to purchase that foreign asset, held for an immediate or a future benefit of yours, then you will have to necessarily file the ITR. Not only that, you will have to disclose under Schedule FA. Schedule FSI, for which I would like to show an example. I have taken an example where I'd like to show some kind of a dividend that a client had received twice in year. Here, the dates are of last year. However, the law remains the same. Rule 115 of IT rules will have to be applied to. Let us say I have received X company's X Inc.'s dividend on the fifth month, that is the 3rd of May 2022. The rule says that I will have to translate 1565 euros into the exchange rate that is on the last day of the previous month, in the month in which I have received my dividend. So when I received the dividend was 3rd May, the previous month is April, and the last day of that previous month is 30th April. Likewise, if I've received any dividend on the 8th of October, the previous month is 30th September, and the last day will be obviously 30th. I will take the exchange rate of these two dates and multiply the euros to find out my INR income to disclose it in Schedule FSI foreign source income. What happens to my taxes paid outside India? I need to show the same rate for translating the taxes paid outside India. To claim the benefit of that in my ITR and show that this is what has been deducted upon and some kind of a credit will have to come to me under Rule 128 and file Form 67 before I file the due date. The total income will have to be determined in this column. So I will say my total income is 1.26 and approximately that is 32%. Now 32% taxes have been paid on this total income and 40 lakh includes 2,75,000, which is a foreign income. So my average tax rate in India is 31.97. The same rate is what I will apply on my foreign income, which is 2,75,000 into 31.97. So I will apply my average tax rate into the foreign converted INR income and compare that with the actual taxes that have been deducted outside India, and I will take lower of the two and claim the treaty benefit under Section 90 of the Income Tax Act. So totally, income from other sources, dividend will show 2,75,000. Schedule TR will show the breakup of your taxes outside India. Also, the tax that would be payable in India had this been a direct income in India. Let us go back to the slide. I will be showing my total dividend under income from outside India, which will be clubbed into part BTI under column B. I will show 87,000 under column C. The tax payable under normal provision of income tax will be totally 80, so the tax payable on such income under normal provision in India would be 87,000, whereas the tax paid outside India would be 96,000. And hence I will take a relief whichever is lower. I will have to also quote the relevant provision of the treaty under Section 90. There are two columns which are very important to be seen in capital gains schedule. If you are claiming any treaty benefit, you will be disclosing the article under which you are claiming that treaty benefit under the capital gain schedule. I've already covered Schedule AL. In case you have crossed gross total income of more than 50 lakh rupees, but you do not have any kind of disclosure under Schedule AL, you have no assets, you have no liabilities, which doesn't seem to be a scenario. But yes, some kind of assets may not apply to you. You will have to show a zero against that. So example, I don't have a yacht or a motor car or a bullion or an investment. I will show zero. And perhaps I will only show my bank balance account in Schedule AL. Schedule AL needs to be filled entirely like no other case in kind of business profession. This is Schedule TR, which we just saw. We will have to select the country code and TIN will have to be shown here. Now, in case you do not have a TIN outside India, it is very difficult to claim the foreign tax relief. However, for those non-residents who are filing Indian income tax return, can show in their static information passport number when they don't have a TIN. Right now, we are talking about resident but ordinary resident who have been taxed doubly outside India and are also taxable in India. The breakup automatically will fall in place. Close look should be seen at row number 4. In case the assessee has got a refund of the foreign tax credit outside India, please make sure you are not claiming the tax credit because that will become double tax avoidance. Possibly a letter of representation will have to be taken from the client that you are not going to receive the refund of the foreign tax credit. Few days ago, Mint newspaper showed an example of how foreign stock are declared in the ITR, which one can see. It is still available on the Google website, and you can just do a small Google search and it will pop up. Schedule SPI, PAN of the person with whom you are having a relation, your spouse or your child. Again, an optional, but a relationship and name will become mandatory. After putting the amount, you will have to also mention under which kind of head have you classified the income. If you see Schedule IF, which is applicable in case of ITR 3, where you're a partner in a partnership firm, the capital balance as of 31st March in the firm will have to be disclosed. Now, what is a capital balance? It is very clear that you will have to only show the fixed balance and not the fluctuating capital balance, which is not required in this case. Please make sure if you're applicable, if your firm is applicable to tax audit, if your firm is applicable to transfer pricing, a proper tick has been put. Otherwise, the intimation will be processed as 31st for FY 22-23 as 31st July and not for later due dates. Schedule OS has one more line item in case you have lost an exemption on the interest on provident fund. Section 10, subsection 11 and section 10, subsection 12 talk about the provident fund where you have made an investment as an employee. Up to rupees 2,50,000, there is no problem because any kind of interest that one earns on that provident fund will be totally exempt. But in case the investment is more than 2,50,000, then the interest will become taxable. In case your employer is not contributing to that PF, the threshold will increase from 2,50,000 to rupees 5 lakh. In that scenario, if you are earning any kind of an interest, then you will have to disclose that interest income in IFOS, which is actually your Schedule OS other sources. Why are we looking at no account case? No account case is applicable for those assessors who are not mandatorily required to maintain books of accounts, whether you're presumptive taxation, whether you're not applicable to section 2 of 44AA, you're not applicable to subsection 1 of 44AA. What are these sections? Professionals who are earning gross receipts, specified assessees under 44AA, doctors, engineers, film artists, technical consultant, gross receipts of more than 1,50,000 have to mandatorily maintain books of accounts as long as they're not going for 44ADA. If you are not of these specified assessees, you are a normal business individual, you will have to see whether you have crossed 25 lakh rupees as gross receipt in one of the 3 earlier financial years or the same financial year, or you have crossed total income taxable from business income of 2,50,000 in that year or earlier 3 financial years. Unless and until again, you're going for 44AD. So when books of accounts are not maintained, you'll have to see whether you are applicable to no account case. The answer is yes. No account case is very mandatory, but in case you do not have any kind of debtors, creditors, and stock in trade, you can simply put some kind of a figure for cash balance. What if you do not have withdrawals? You can simply put rupees 5,000 or maybe 10,000 so that you can at least file your ITR. Pass-through income can be filled by seeing Form 64C, which is issued by the investment companies, the capital funds and the venture funds that they issue you, and they give you a total breakup of what income goes to capital gains, what income goes to dividends, and what income goes to any other head. TDS thereupon will be reflected in your AIS and TDS 26AS, which you will have to show here separately. Details out of this, because you are specifying the head of income, will fall under the next block, which is your different blocks. So if I say OS, and this is the amount, however, the amount will not match in my example, the amount will sit in the nature of pass-through income coming from scheduled PTI. So first is you will have to fill scheduled PTI pass-through income for those assessees applicable to rule section 11 UB and so on. And then you will have to go to scheduled PTI and other schedules to double check that all items have cross-tallied. Capital gains from PTI, whatever is the charge of tax, will reflect here from the same schedule. Now, what are my due dates of Form 67? Form 67 is the form which I have to file under Rule 128 to claim the foreign tax credit. If I'm filing an original return, I can file Form 67 before the end of assessment year. But I said earlier that this form should be filed before the due date of filing return, so it becomes easier for an intimation to be processed. However, it can get into litigation and representation if you have not filed it, and then you can show the rules. Belated return and updated returns have a different rule because belated and original return look the same. You can file Form 67 before the end of AY, but for updated return, you will have to necessarily file it before the date of filing ITR. I will be, as an individual, put under the old regime when I'm filing my ITR as a default assessee. If I filed Form 10I earning business income in previous year, I can file my ITR in the new regime. Now, what if I have been filing my ITR under the old regime? What do I do? If you are not under any kind of business profession, earning no income from there, then you can have an option to not file Form 10I and hop, skip and jump from old regime to new regime according to your benefits. What happens if my TDS is deducted under another different regime? There is no repercussion, but one will have to check the tax impact, because in case you have opted for new regime and you want to go for old regime and the taxes are higher, you may have to pay some kind of an interest. Is 10I mandatory for those who do not have business profession income? Answer is no, it is not mandatory. Only if you have business profession income, you have to file Form 10I. Can I opt out of new regime? Yes, you can opt out of new regime if you are a business professional only once in lifetime and not thereafter. What happens next year? In the next year, the new regime will automatically come as a default regime. Now, if you want to go back to the old regime, you will have to perhaps file Form 10I and not go back to the new regime because you are earning business profession. What if you're not earning business profession? Again, you can do a hop, skip and jump from new to old and vice versa. Domestic companies filing under new regimes. One is 25%, which is 10IC, 22% 10ID, and 15% 10IE, separate incorporation dates, separate rates. For those companies who are opting for 10BAB and 10BAC, cannot claim MAT, so they will have to comply with the provision lifelong. What happens to those domestic companies who are taking a charge of 10IC as well? As I understand, again, you will not be applicable to MAT because you've gone for a new regime. Cooperative societies will be charged at 22% if they go for a new regime for 115 BAD and will have to file 10IF. All these forms will have to be filed before the due date of return, and the acknowledgement and the information of that form will have to be mentioned in your respective ITRs. Here are a quick look of the tax slabs for individuals and HUF. Another important element of ITR 5. Let us say I am a gymkhana and I have 2 trustee members who are handling the gymkhana, and hence I'm filing ITR 5 as AOP BOI. So that the gymkhana doesn't get taxed at maximum marginal rate, I will have to show some kind of a percentage share determined. If there are 3 members, I will have to show 1/3, that is 33.33, 33.33, and 33.34. If there are 4, I'll have to show 25. Here there were 2, so I showed 50%. I'll have to show their PAN. Aadhaar is actually compulsory, but if they were not eligible to getting an Aadhaar, say one of them was a non-resident, then you may skip it. Status of those members. Likewise, you will also have to show the details of your estate's members in this schedule. If you are a partner in a partnership firm and you're filing ITR 5, entire detail will have to fill in, including the rate of interest on capital. Again, interest on rate of capital will be on the fixed capital and not fluctuating capital, but there is no problem even if you want to show that. But the problem arises that you will have to show more columns and possibly ITR may not go forward and create a JSON. So it is better you show a fixed rate of interest on the fixed capital and avoid showing or disclosing interest on the fluctuating capital. However, since you are showing remuneration payable as well, as a partner, I will have to disclose the remuneration payable in my ITR, even if it is received after the 31st of March 2023, and tax it under PGBP, that is Schedule Business and Profession. Schedule TDS, as I said, deduct in own hands, column number 8, and deduct in others' hands, 7 and 8, is where your 37BA, Rule 37BA will come in place. what is the financial in which TDS is deducted? So when I am bringing forward the TDS of earlier financial year that I've not claimed in the past, possibly because I have not claimed it as I was under cash basis of accounting. How do I know how to put the year? Because the year comes in Y format. So always think of the 1st April of that year of which you are claiming your TDS. So let us say my TDS is deducted in financial year 2019-20. I will put here 2019 because in the month of April 2019, the TDS was deducted and carried forward to the return of financial year 22-23. TDS credit of the same party can be carried forward. How would I fill this for a single party having a lot of brought forwards and a carry forwards? Preferably, I would show 2 line entries, one for a brought forward and being consumed, and another one for showing from 26 AS of the current year, claiming however or how much ever I want to, and then carrying forward the balance. Because usually while processing the data, the CPC gets really confused and can start throwing you any kind of an intimation. Static information in case of audits applicable. Be very careful whether you're applicable to 44AA or not. Please do not say no when you're filing for partnership firms. You're filing for individuals who are applicable for tax audit as doctors, professionals under 44AA. Because if you say a no and you put a tick under Part B, where you're liable for 44AB, there can be a JSON error. Even if there's just no JSON error, which I believe you will get a defective notice or a kind of a revalidation or resubmission will have to take place. This section actually will have to be done very carefully. Under which clause, under which category are you going for tax audit under the income tax rules? In case you're applicable to any other audit, you will have to fill Part E. So let us say I'm a private limited company or a public limited company or a partnership LLP. I will have to show the section under which I'm applicable and show under which date have I filed my audit report. So if the statutory auditor is issued the date of audit as 10th of September 2023, you will have to show the date accordingly. For LLP, you will have to go for LLP Act 2008 and Companies Act 2013, and respective sections will have to be shown. What happens in case I'm applicable to SEBI audits as a broker and I'm a partnership firm doing broker work or commission income? I will have to show the same here under Part E. For ITR 7, one will have to mandatorily report the following audits if done under transfer pricing or 12A or 1023C, whether you're an education trust or a hospital or any other government body. What happens to AIS? I have 4 to 5 options which are mainly important. I do not have to necessarily say information is correct anymore because AIS will have to be compared with ITR by CPC and even by the tax filers and the professionals, that is us. You will have to say if the information is correct or not. So just say information is not correct. If it is correct, let it be. If information relates to any other PAN or year, so either you're carrying forward the TDS or the income because you're on cash basis, or you are saying that the income belongs to any other PAN, you are not claiming it, somebody else will claim it because you've missed out on Rule 37BA declaration. Let us say I'm a father and my 2 children's income is being clubbed under mine. So the kids will have to say the information relates to other PAN. At the moment, for those minors whose PAN has just been applied, they cannot create a CPC portal. For those minors who already had a CPC portal, you can go to the 26AS and say, this income belongs to my father. Put his name. Automatically, when you put the PAN, his name will appear, and then you can say in which year he will be clubbing your income with his. There is a possibility and 100% chance that you will get an intimation, but once you click on a reprocess, the ITR will become validated and it will be accepted as a proper return, and intimation will clear out all your demands. So the return will obviously be uploaded. In the intimation, you will be asked that why have you claimed TDS which is not in your AIS or 26AS. So you will just click on reprocessing. In case the reprocessing doesn't work, at least once you will file a rectification. When I say rectification, you will file the same ITR once again under that intimation. When anything appears on my AIS and it is not my income, obviously I will deny that information. There are two heads under which I can actually give a customized feedback. I can put some kind of a remark. One is under information to other PAN and duplicate, include other information. The ones that I've highlighted is where I will get a remark box, and that is where I can put my customized feedback. Download your AIS after you've given feedback, and also once before you start giving feedback, so you are aware in case of any intimation arrives at your doorstep, rather your email. Some important things that you must take care of. You must know your ITR before you start preparing. Every ITR, every schedule, every clause, every part of that clause will explain what it is asking. Hence, please collate your information according to that ITR form after reading it. Before you start filing, pre-validate your bank account. In case you are a foreigner, you want to claim the refund in your foreign account, you can inform your SWIFT account in bank schedule. Residential status schedule section 6 is very easy now because the entire section 6 is encrypted in the ITR, and it will actually show you that whether you are applicable to be a ROR, NR or RNOR. In case you become NR, you will automatically come out of ITR 1. So be very careful to determine your residential status before you select the ITR or Excel utility and convert to JSON. Responding to AIS becomes very crucial, as we said, and quoting the Aadhaar in the ITR is very important. From 1st of July, 26 AS actually starts showing whether your PAN is inoperative or not, because you had linked it earlier or not, is the reason why it will disclose that information. As I said, passport number is okay if you do not have TIN in case of non-resident. If you are a non-resident and if you are a person of Indian origin or a citizen of India, you will need to disclose a number of days in India for that FY, which is FY 22-23 and 4 preceding financial years. You will have to register digital signature certificate wherever applicable. What happens to digital signature in case of ITR 7? ITR 7 actually does not mention anything about digital signature certificate. You can even send a manual copy to Bangalore. But however, if you are applicable to Form 10, Form 9A or Form 1010BB, which are your audit reports under the Income Tax Act of Charity, then you might as well use that digital signature for filing your ITR 7 to finish the matter ASAP. Reading the ITR becomes very important after you have prepared it to see that all clauses and all the sections are parallel and are in sync with each other. There is a possibility you want to avoid all JSON issues. Hence, please do check the mathematics, because even if the JSON is created, I had an experience where a JSON was created, although the self-assessment tax was not entered into, and the ITR got uploaded, and then comes the defective return notice saying that please correct your defect because SA tax details have not gone into. So one will have to be really cautious while filing the ITR. E-verify the ITR immediately if there is no other OTP or DSC. Now, when I say e-verify, means that the client will have to immediately send you the ITR V copy or speed posted by themselves. The date of the speed post will be considered by CPC as the date of e-verification. You will have to automate process at your office. You will have to create templates, possibly for bank summaries, schedules that you will have to send to client to fill, their accountants, their team. Do prepare notes to accounts to know what is the method of accounting in case you're preparing financials for individuals, HUF partnership firms. Private limited company becomes very easy because you have a ready tax audit or perhaps a stat audit team with you to help you file the ITR. Do check if the brought forward losses of the previous year have come in correctly and see the set off. Here is how the set off will happen. Current year's long-term capital gain can be set off even in the next year. Short-term capital loss can be set off in this year along with long-term as well. And in the next year, against short-term gain and long-term gain. Rule says that the current year short-term capital loss and long-term capital loss will first have to go against the current year long-term gain, the highest of the taxed income. So it is beneficial for the assessee. However, even if you set off against short-term, there should not be a problem, but intimations could arise, but that could be in your favor for once. Why am I explaining a dead loss? Since the time Section 112A has come since Finance Act 2018, we have to apply the rules if the shares were purchased before 2018, 31st of Jan. So let us say ABC Limited, the selling price was 150 and the fair market value, the cost price was 100. My actual profit would be 50 rupees. However, now I have to compare the fair market value 200 with the sale price, which is the lower is 150, and set off higher of the two, that is 150 has to be compared with the cost, and I will have to show 100. In this case, there is a dead loss. So the 50 rupees dead loss is actually foregone. This doesn't mean that in schedule 112A section, you are actually letting go your loss. Eventually, money-wise, you're letting go your loss, but you're following the provisions of section 112A. And because of that, you may have to follow for clarification FAQ on LTCG, which was released on the 4th of February 2018. How do I disclose my quarterly income dividend? If I'm not an HNI, I would like to show all my dividends under the first quarter to avoid any impact on my 234C interest on advance tax. But in case I'm a high net worth taxpayer, I will have to do a reconciliation so that all kind of dividend which have been earned or are accruing in the financial year will have to be blocked out according to the quarters to save me from an impact under 234C. This will not have any impact on senior citizen. You select any block. However, you want to be righteous. So it is better you put on the 15th of June because senior citizens who are not applicable to PGBP, business or professional income, do not have any impact on interest on advance taxes. What will happen in case of advance tax? In case of dividend being shown separately under different quarters for non-resident, non-residents are specifically taxed under 115A at special rate of 20%. I do not think there'll be an impact on advance tax in whichever block you may show, because on totality, your TDS would have been deducted under 195, and perhaps also that you might be claiming a treaty benefit. So let us say my tax is deducted at 20% and my TRC is available and I'm claiming the treaty benefit perhaps at 10%, then there will be a refund of 10% in my ITR. Perhaps for the conversation, I'm ignoring all the provisions of 206AA and surcharge and excess for easefulness of understanding. ISIN is not mandatory for non-grandfathered scripts under 115.12A. There was a press release on 26 September which says that in case you have 112A long-term equity-oriented or equity shares sold, which were purchased after the 31st of Jan 2018, ISIN is not mandatory, and hence I can put one single line item for all the scripts in one total column. So let us say I have two scripts, TCS and Tata Motors, that I had purchased after the 31st of Jan 2018. The total purchase cost was 10 lakhs. The total sale price is 50, 40 lakhs is my capital gains. I will show one single line item by calling it long-term capital asset. However, my team has told me that there is a possibility the broker can make a mistake. What the broker has done is he has shown it under short-term capital gain. While we punch the numbers and the dates into the computation, the answer was a long-term. So for the sake of clarity, either you prepare a RICO or directly start punching into the software script-wise. But for those small investors, you can take a chance of putting single line items. If they're mutual fund equity shares or equity shares alone, then you can show two different line items. So one will be equity shares for non-grandfathered and equity-oriented mutual funds non-grandfathered. A reconciliation of GST will have to be prepared. The GST schedule in the ITR for all ITR applicable is as per Form 3B. The same details will appear in your 26 AS. Please do a reconciliation with the turnover, whatever you're showing in the profit and loss account, and also that you are disclosing in the ITR under schedule P&L, or perhaps no account case. Before I go to disease, one important point: while I fill no account case, I will have to show the turnover in no account case when I'm opting for presumptive taxation, or I'm not opting for presumptive taxation, and I'm disclosing my total income, business income, under section 28 to 43C. So no account case appears at both places, under the balance sheet and also under profit and loss account. One will have to see how it is being connected. It is very easy. Whatever is a net profit under no account case directly goes and sits under schedule PGBP. What happens in case you are filing a return for the decease? In case of a decease, in case of a decease, if you're a legal heir, you will have to go to the profile of the person who has passed away. You will have to upload the PAN of the legal PAN of the deceased, your own PAN, death certificate, and a legal heir proof. Now, what is a legal heir proof? If I am dead and my son is filing my legal heir return, then he will have to upload my will, where I've clearly mentioned that he's my legal heir. So possibly you will have to get the wills drafted accordingly in the future course of action for whom you're filing. Second, in case you do not have a will, you may have to get a PIT or a court's order, because without which, it being a mandatory field, the process will not go forward on CPC profile. As soon as that is accepted and a submit button is clicked and a submission confirmation has come at your end, the profile of the deceased will get locked. Once that is locked, you will have to start filing the return under your own profile, being the legal heir. So now if my son logs in, he will see the legal heir of Divya, and he himself, let us say his name is Ashok. He will have to pick the legal heir point, log in with a user ID, password, my PAN, and the password that is created, and file the ITR. All the income that I have earned till I died for the financial year will be shown under that category. However, he will have to create an estate after the date of my death, possibly apply for a new PAN card, and file another ITR and create one more category there. So for example, estate of Walter alias Disney, ITR 5, one will have to log into CPC of Divya, and the verification now will become a representative in both cases, whether you are filing up to the date or after the date of death. Let us say I have died and I had one house property in my name, and then after my death, it becomes a house property of my son. Both of us, that is, as my legal heir, if he's filing, he will have to show under my legal heir category ITR, and he'll have to show the same house property under his ITR for that FY. In case of LOPs, of course, the incomes will have to be separated out. One will have to do a reconciliation with 26 AS, and one will have to kind of show if the TDS has been deducted in my PAN and the son is claiming that TDS. Easier way, possibly I could take a chances till 31st of March, whether I am dead or not. I would file my son would file my ITR under my profile, and then do the legalities thereafter for the sake of clarity. 139.1, while we filing the ITR is being filed by all individual HUF mandatorily as long as they are crossing the threshold of slab rate. If you're a company, there is a mandatory requirement to file the ITR, including firms and trust. But if you're an individual not crossing maximum chargeable to tax, and if you're applicable to one of these conditions of the 7th proviso, you will have to mandatorily file the ITR. What if I'm applicable to the 7th proviso and I've also exceeded the maximum amount not chargeable to tax? You can put a tick under that category under static information that yes, I'm applicable to 139 subsection 1(7) proviso, but preferably, even if the option is available, I would not tick it on, for the simple reason being, it shows us that just because I'm applicable to 7 proviso, I'm filing the ITR, whereas the case is I'm filing the ITR because I've crossed the maximum not chargeable to tax as an individual. Revised return and belated returns can be filed before 3 months from the end of relevant assessment year. Hence, your due date is 31st December. You cannot carry forward losses in case of belated ITRs except for UD, unabsorbed depreciation, and loss from house property. Of course, the loss from house property is only up to 2 lakh rupees now. When do you know the form you are selecting is correct while you are revising the return? If I'm revising my return and I've missed out on any kind of an information which is applicable in some other ITR, I can change my form. But if I'm filing a defective return under 139 subsection 9, I would not call it a defective return. I would call it as a response under 139 subsection 9. I will have to file the same return, and possibly, if I miss the deadline, file an updated return, or if the time permits, I may have to file a revised return. So you will have to be really cautious that you do not get any defective return, because there'll be an original return otherwise, a defective return. Then if you realize there was a mistake, you revise the return. And again, if there is a mistake, you do an updated return. So you will be actually filing 4 returns for an assessee if you make mistakes. Updated return ITRU, follow Rule 12AC, Section 139, 8A, question 10 and 12 of the FAQ of taxmen explain the logic of who is applicable to ITRU. You can only file one ITR per assessment year. You cannot file a nil or a loss return under ITR, which means that in case you have no income, but you want to still file ITR for the sake of passport, etc., you will not be able to file it. How do I know what is my additional tax? All the taxes that have been paid will be given a credit for under section 140 capital B of the earlier ITR. But there will be an additional tax because there's an additional income that I'm disclosing in ITRU if I'm filing up to 12 months. Otherwise, it'll be 50% additional tax up to 24 months. ITRU is a little cryptic because it's a 3-page form. I could not see any information about showing the turnover. So let us suppose I missed out on showing PGBP income and I have crossed 31st of December 23. So on 2nd of January, I'm thinking, should I file ITRU? Answer is yes, I missed out on showing my PGBP. It just says that you need to disclose the taxable income under PGBP. It does not ask you for your turnover. So how does one know whether tax audit is being filed? How does CPC clarify whether transfer pricing was applicable, so on and so forth? This will need clarification, but I suppose that CPC, at least for now, will see 26 AS and AIS and throw you some kind of a query thereafter. The acknowledgement of earlier ITRs will have to be shown. So if you've filed a belated return or a revised return and an original return there too, you will have to show their different acknowledgements and the return filing date. Acknowledgements would mean that they have been e-verified and not the number which has been punched in ITRV. You will make sure that your ITRV is clearly verified and you have an acknowledgement number before you file ITRU. Here is some information about 810 clause, which is in your ITRU. You will have to put a categorical tick, reasons for why you need to update your ITR. Outside the ITR, you can file all kind of requests now online. Condonation of ITR was actually manual before. Now it has all gone under CPC profile. So you have a different request that you can make for refund, reissue, condonation for time by ITR, and condonation for including ITR verification, which is time bound. There is a button called new request under those categories. So once you log into your CPC profile, you will be able to see condonation request header under one of those drop downs, and then you can keep going further. For now, it is very easy to use. Here are some ITR numbers that we would like to see. The page numbers, very massive. One will have to take a close look at what we are going to go through from July up till perhaps November. And I'd like to thank BCS for having me today and listening to me very patiently. Thank you, everyone.
Thanks, Divya. I think there are quite a few of questions if do you want me to read, or will you be able to open a Q&A tab?
Yes, I will.
Yeah.
I'll try my best to answer these.
Yeah.
The question is whether filing Form 10 is mandatory in case of utilization of earlier year's accumulation, but there is no accumulation for the previous year. The answer is no. In case you are filing, you are spending from last year's accumulation, you don't have to file Form 10. Form 10 is for the immediate financial year. So if I'm accumulating any income in the current year, I will have to file Form 10 for the year. However, while I am filing Form 10 for the year, I will also have to show the earlier year's accumulation. I understand that because the Form 10 is asking for earlier year's accumulation also, and current year there is no accumulation, do I need to file Form 10? There is no specific rule given in the income tax Rule 17B and Rule 17, which is extrapolating to Form 10. Hence, I would say no. Whether utility for ITR-A modified has been released, presently, I am not able to see ITR-A at the moment, so I'd say no. Where and how to show option, call and put turnover and its profit or loss in the ITR. So call and put, I understand, are derivative income. Hardik, you can correct me if I'm wrong. So in the case of
Correct.
In the case of derivative income, it is not a speculation income, and hence I would put it under profit and loss account under PG in the case of sales from securities or sales of other items. And however, you have mentioned that there is no problem because your PGBP schedule has to be accurately be computed for the purpose of this income. In case of private trust holding shares, the DMAT has PAN of the trustee, and hence all TDS appears under the trustee's PAN. First, you will have to notify the deductors to deduct the TDS under the correct PAN. However, now to claim the TDS, you will have to go to AIS and inform the AIS that, this is not my income, it belongs to any other PAN. More importantly, still time for you to file a revised TDS return. So you can tell your deductors to file revised TDS return. Possibly it will become a mammoth task because there might be a lot of deductors. You can take a chance for now and then possibly fight it off during intimation. DMAT account does not accept any declaration. Fair enough. DMAT at the moment will not accept any declaration, but henceforth, for the next years, you will have to do the same process. In FLA, where the details of assets as of 31st March are to be declared or 31st December, I understand FLA is for FEMA, but Schedule FA is for foreign assets. So foreign assets will have to be disclosed for the calendar year as like foreign country. So even if I am in financial year 22-23, the assets that I have from 1st of Jan 22 to 31st December 22 will have to be disclosed.
You want me to ask questions?
I'm okay. I'm okay. Thank you.
Okay.
Is the company or LLP or firm having balance sheet? Is the company or LLP or firm having balance sheet? Is it required to fill AL statement? Fair enough. For the private limited company, Schedule AL1 will be applicable, but if you're a startup, you will have to fill Schedule AL2. Yes, they're mandatory schedules, even if those assets and liabilities are in the balance sheet schedule, you will have to show them separately. A detailed working will have to be given. What is the purpose of the asset, whether you're using it for the company, whether director is using or any other. In the case of LLP or firm, at the moment, I do not see any Schedule AL, but before that, I do not mind seeing because I have a plethora of all the ITRs lying with me, and we can take a close look at ITR 5 for a second. Fair, we do not have scheduled ITR 5, so there is no problem, I suppose. Is the BOI or AOP being a mutually entity like clubs is liable to 3CD for the purchase of wine, etc., sale to members? My answer would be no, because there had been tribunal decision where the principle of mutuality was questioned, and the tribunal said that the members of those clubs, where clubhouses and the gymkhanas are being, the income is being earned for their benefit, and the monies are being spent for their benefit. Hence, I would say this may not be called a business income unless and until the deed or the inception document would call it otherwise. Perhaps that would have to be checked. Since it is a mutuality entity, a principle of mutuality comes into existence, where would you show your total income? Perhaps you will have to show it under IFOS, because as long as you're showing under PGBP or profit and loss account, the trigger of 3CD will come through CPC. So sometimes we have to understand ITR 5, again, like ITR 7 is quite cryptic. We'll have to see the inception document. We'll have to see the nature of income, the nature of receipts the club or the gymkhana is receiving, and match it with some kind of a tax logic. When the minor interest income is club in the hands of parent, is 206AB attracted? And whether the deductor is liable to deduct at 20% since the return is not filed by the minor. Quite a nice question. According to me, I would say that 206AB should not get attracted to the minor's income, because minor is not liable to file the return of income. So legally, if I'm not liable to file the return of income, 206AB should not apply. And maybe a declaration will have to be given about the provision and the section to the minor's deductors. Hence, TDS should be deducted as per normal rates, preferably with the kind of havoc CPC is creating in a proper and a nice way, and being so professional with the taxpayers. I would like to say that gone are those times that you could make investment in name of spouse or in the name of minors. But if you have so, and if you need to do so, we'll have to be cautious. What are the pre-filling options and applications available for assessment 23-24? I understand that presently this is too detailed an answer. One will have to look at the Excel utilities that are available on CPC. ITR 6 Excel utility is still not out. ITR 1 to 5 and 7 are released. So one will have to actually go to those clauses. But for all the ITRs, there is an index page which shows all the schedules. One can click on it and do a check. Filing of dividends data is painful exercise. Yes, thank you. Particularly where TDS is not done, I understand. And what is the relief from such pain caused by the amendment? Hardik, I'm not too clear. Could you explain this?
No, I think so. It was just a comment. And I think you can't.
I think this is more legal than the ITR part, I feel.
So, so what I understand is what he's trying to say, that how to collate and put that data of this. I think that is a problem.
So one will have to do a reconciliation quarter-wise. If TDS is not being done, then you'll have to refer to the bank statements, and you're not doing your bank summary, then prepare a bank summary. AIS will obviously show the information of dividend. If AIS is not good enough or you think it is less, then you prepare a short summary, short working, collate the information and show it under IFOs. What is the due date for premises of cooperative society claiming deduction under 82 subsection 2? I feel it is still 31st of July 2023, as long as you are not under business profession, are not applicable for tax audit. Accumulated income and corpus donation has to be invested before 31st March or Form 10 filing due date. Okay, the answer is for the purpose of information, you must do it before filing of due date, and for Form 10, because Form 10 is applicable to the accumulation of income, whereas corpus donation has to be before 31st March of the financial year. So there are two different questions in the same question. Corpus donation will have to be invested in 11.5 modes before 31st March of 23. In case not done, perhaps it's a bit late. And accumulated income should be done by passing a board resolution, filing Form 10, and showing that under Schedule I, Schedule IA, and Schedule J perhaps in your ITR 7. What is the consequences if any authorized person signs and sends the ITRV speed by post? There is no problem. I had a simple case last year where the mother-in-law was 101 and the daughter-in-law calls me saying, I have a power of attorney for mother-in-law. Can I sign ITRV? I said, yes, you can sign it. So Mrs. A was the senior citizen, super senior citizen, being 101 years of age, and the daughter-in-law could sign it. So she said, Mrs. B, power of attorney of Mrs. A, and the ITRV was having no problem. We got an acknowledgement and it was done. In case you get a question, the only way to combat, although I know I'm speaking online, is that you can just write the name of the person and send ITRV to Bangalore. Please make sure you are sending ITRV to Bangalore by signing in blue ink. Today's ITRV is very easy if you refer to the rule book or any ITRV that you filed and you have it up front. There are 4 to 5 paragraphs which are very self-explanatory and easy to understand. What is the verification checks and balance in CPC for signature matching? I may not be able to comment on it. What if assessee has undergone surgery and can't sign or verify? You refer to section 140 where the signatories are informed. If in case you cannot sign because you're of unsound mind, you're absent from India, or you are unable to sign, you can take a power of attorney in advance if you're going for surgery, planned surgery, and sudden issues, you can just sign presently and backdated the power of attorney in case. And if not, you can just put the name of the assessee and send it to Bangalore. Why cannot the department arrange collection of ITRV at our center instead of sending CPC? I completely understand, but I'll try to refrain from the question's answer because it is not related to the ITR at the moment. Now, Google Inc. and Microsoft are listed in Stock Exchange of GIFT City. Whether such holding needs to be disclosed in Schedule FA? Answer would be no, because Schedule FA says assets outside India. Now, if I go for a literal interpretation, GIFT City is inside India, although it is considered as a foreign location. But I go one step forward. What if you have unlisted shares in GIFT City? Are you required to show unlisted GIFT shares, unlisted GIFT City shares in unlisted shares box? So the answer would be, if I have shares in the GIFT City which are unlisted, I would say yes, I would show it, because unlisted shares during the previous year, whether in India or outside India, are to be disclosed. Perhaps the answer presently in here would be I can skip disclosing in Schedule FA as long as I'm ROR. Anyway, non-residents do not need to disclose Schedule FA at all. Also, RNOR are not required to disclose anything under Schedule FA. If a foreign shares were purchased in September 22 but sold in January 23, will these shares appear in Schedule FA? And also, capital gain will be reported in the ITR? The answer is yes, because from 1st January to 31st of December 22 calendar year, anything that you purchase and sold or held as a foreign asset will have to be disclosed in Schedule FA. If you have sold the assets in January 23, the question arises, what happens to my FSI? Foreign income, foreign source income has to be shown for the financial year, as I suppose possibly Rutvik or Hardik could clarify, and you will have to show the income for the 31st March 2023 return. The question would arise is what happens to my tax credit in case if any. The tax credit will have to be worked out under Rule 115. Schedule TR, Schedule FSI will have to be worked upon.
So Divya, what I see, there are many questions on foreign assets schedule, and even the foreign income. What because of the paucity of time and I think the interest which has been developed, we might come out with a separate program on the same. So I would right now just tell you if can skip those questions and concentrate on others because there are plethora of questions.
Sure, I'll do that. Can an assessee revise the return in a different ITR form? Yes. If tax have been paid in foreign country, okay, so I'll skip anything which says foreign country on foreign assets. Anything which looks foreign is what I will ignore. What is the due date for filing Form 64? I think you are talking about 64C. So it was 30th June 2023. If ITRV is not verified, can different ITR be filed in place of original ITR? If ITRV is not verified, eventually it will become a invalid return. Invalid return means the return was never filed. And possibly answer is yes, because you can choose whatever ITR return you want to file as if you're filing the original return. If PAN is not linked with Aadhaar, can the ITR be filed? If you are applicable to filing, linking Aadhaar with PAN, there is a possibility your PAN has become inoperative as a date. So CPC may not take it forward. I have not tried it practically, but I'd say there could be an issue. Indian citizens working in the merchant navy and staying more than 180 days outside India, is he considered NRI? Section 6, subsection 1, subclause C. It says Indian citizens working in merchant navy or staying outside more than 182 days. The second condition will have to be taken into consideration, where we are talking about the 4 years criteria. The 4 years, 60 days are becoming 182 days. Since the person has crossed more than 182 days in the current year, but in the last 4 preceding years, he was in India, he will still be a resident and not NRI. Is the feedback on AIS compulsory? Yes, the feedback on AIS should be done. Rather, it's not compulsory by the law, because the CPC will compare the AIS information with the ITR processing when they are seeing it at Bangalore office. So it is required that AIS information is replied to. As long as the information is correct, you're fine. But if not, you will have to respond.
Divya, what I will say, if you can just give some glimpse on this derivatives reporting. What I have seen after reading the questions, there are 8 to 10 questions which are just on how to report futures options as a turnover and in the schedule and then the return of income. So I think if you can just give 2 minutes to that.
Yeah, sure. So as I understand, the FNO income has to be computed according to the guidance notes. So I will not look at the income. Presently, I am computing the turnover mentally. So my turnover from FNO or speculation income will be the summation of my negatives and the positive, and that is my turnover. If that turnover exceeds the tax audit limits under 44AB under business, then I will have to necessarily go for tax audit. If not, then I will have to skip tax audit and file an ITR on 31st of July. The question arises, how do I disclose this turnover in my profit and loss account? The disclosure of profit and loss account is very simple. You will have to show it. We can see it actually on one of the ITRs. I can open a scheduled P&L, so it becomes more easier. Just a second. So I'll directly go to the profit and loss account, or I can even remain in the trading account for a individual or non-individual assessees. Here is revenue from operations. So I will not call it goods. Can I call it sale of services? Perhaps not. And I will have to possibly show in other operating revenues and say derivative income and show a figure here. Out of the derivative income, if I'm disclosing expenses under 28 to 43C, I will show expenses in profit and loss account. If I have crossed the turnover for more than 25 lakh, books of accounts will be mandatory. If I've not crossed 25 lakhs, I possibly can ask myself a question. Can I become an eligible assessee under 44 AD, even if I have not reached 2 crores? So let us say there are 3 to 4 brackets under which I'm thinking at the moment. My total turnover is less than 25 lakhs. Can I show 8% of 6% of turnover? Answer possibly could be yes, because.
Are you sharing your screen? Because participants are saying that they can't see.
Okay, I will share it again. I'll just finish my point though, and then share the screen.
Yeah.
So this is the screen basically for the profit and loss, but let me explain the income element at the moment. If you can see the screen, is that even if I show my, if my cross turnover as computed, the summation of negative and positive is not crossing more than 2 CR, possibly I can go for 44 AD and say I'm an eligible assessee. If I've crossed more than 10 CR, obviously I'll have to go for tax audit. If I've not crossed more than 10 CR, and I have to ask myself a question about 5% of cash receipt and 5% of expenses and take a call. If I can, no, if I do not have to go for tax audit, I'll have to draw the books of accounts because I've crossed 25 lakhs already. But if I'm showing anything less than 2 CR as my turnover and going for 44 AD, the trading account is not applicable, and I will directly go to no account case here and show the total turnover at the end part. I'm presently not talking of intraday. So one is a speculative activity box, which has been mentioned here. Although intraday can tend amount to be speculation, but they're asking for extra information out here. So I'll have to say I have earned 30 lakhs from my turnover of speculative income. 30 lakhs will be gross receipt because there is no gross expenses. Expenditure of any will have to be deducted and net. This ITR, whether 3 or 5, you will have to do it very carefully, because depending on the turnover, applicability of tax audit, and the kind of expenses that you want to claim, and whether you are crossing the 44 AA subsection 2 limits, whether you are crossing 44 AD limits, and whether you're crossing AB limits, you will have to see in sync before you start filing the ITR, and then determine what is applicable. Presently, if you are going for presumptive taxation, you can directly show under presumptive taxation under 44 AD block and close the ITR. If you're not showing under 44 AD, but you're claiming 28 to 43C, you will have to show under 66 number category. And if you're crossing the threshold of maintaining books of accounts, you will have to entirely fill the balance sheet and profit and loss. So that's
Divya,
all.
yeah, Divya, I will ask a couple of other questions which are repeated. What about this ITR-V being delayed and condonation request being filed? So for the first question is whether it is necessary to file condonation request. Second is, what if condonation request is not approved? So this is what they are asking, how to approach such cases where there is a delay in sending ITR-V.
So I will just say the answer in my plain reading, because I have not personally filed it. Condonation request can be done online, Hardik, through CPC profile. And for those who are asking this question, invalidation of the return will happen immediately in case the delay of ITR-V has happened, let us say presently 120 days and further. But in case invalidation has not happened, and even if it has happened, you may want to apply for condonation because it will not disallow you from applying. So you can go to your CPC profile, apply for condonation, click on new request, and go to the option where ITR-V condonation is there. Once you click the submit button, whether it is approved or no, you will know later on. So that is the only process. It will not get rejected on the spot, but it will get submitted. That is all I know presently.
Okay, and one more question: can an updated return be filed for refund?
I suppose no, updated return cannot be filed for refund. CPC is only looking for places where they want to ensure that the income has arisen, the losses have not reduced, the losses have not increased, the losses have actually reduced. So in such situation, refund can only arise if you're doing anything against.
Another question, where to disclose gifts received on wedding in the ITR?
I would say that you should not disclose any gift received on wedding on the ITR because it says exempt. So in case you want to disclose it, you can show under schedule EI, which is exempt income.